Adjusting entries. Adjusting entries are needed at the end of the period to bring your accounts up to date. Generally Accepted Accounting Principles, GAAP, requires that we use the accrual basis of accounting. That means that revenues are going to be recognized when they're earned, not necessarily when the cash is received. Expenses will be recognized when they are incurred. That means when they happen, not when they're paid. Okay? And so there are certain things that we have to make sure of before we create these financial statements, because our financial statements are going to give the users of the financial statements, the people, our investors and the bankers, it's going to give them an idea of how we're doing as a company, right? And so the income statement has your revenues and expenses listed, and the difference between those two is your net income. Well, what if you've got some revenue that you haven't reported yet? Maybe you haven't received the cash yet, and maybe there's some expenses that you haven't actually put into the expense account yet. And so some adjustments may be needed. One example is the supplies account. When you purchase supplies, you put them in the supply closet, and those are assets. It's a resource that you own that's going to help you make money in the future, right? But during the year, you go to the supply closet, you use up some of the supplies, you go back to the supply closet, use up some of the supplies, and at the end of the year, if you were to look in your supply closet, all your supplies are not all there anymore. Some of your supplies have been used up. Those supplies that have been used up need to go into an account called supplies expense. Why is that? Because you're going to match the revenues, the money that you earned, with the expenses, the cost of doing business for 1 year when you make that income statement. And so you need to show a true reflection of your actual revenues and your actual expenses for that year to come up with net income. Now, adjusting entries usually happen at the end of the year, and they include one balance sheet account, or at least one balance sheet account, and one income statement account. Now, there are 5 different types of adjusting entries, and I will record a video for each one of those types.